Welcome to our lecture on international taxation. Specifically, today we are going to start with a topic called transfer pricing. You'll recall that over the period we have been going through series of topics, and like I mentioned in our previous discussion, transfer pricing is one of the major topics that you will have to cover in order to be able to pass paper 9. So today we want to look at the concept of transfer pricing, and in the syllable or in practice we normally refer to it as the arm's length standard. And for the sake of recap, let us look at where we are, especially where we came from. From the beginning of the discussion, we mentioned that taxation is an imposition. In other words, we try to look at the local law, which is the Income Tax Act, and why we had come all this way to say, let us now learn international taxation. So we looked at imposition of taxation. We look at section 1, and we are saying section 1 said that if you have any income during the year, then there is income tax which is imposed on you. If you have any chargeable income, in other words, the word used was chargeable income. And we said that section 1 did not define what chargeable income is, so we had to go to section 2 to look at what chargeable income is. We look at section 2, and section 2 defines chargeable income as accessible income less all allowable deductions. Then we also said that section 2 did not define what accessible income is, so we had to come to section 3 to look at what accessible income is. Then section 3 said that accessible income is all your income from employment, business, and investment. Then if you proceed to section 3 subsection 2, that is where international taxation pops its head. And we said that section 3 subsection 2 said that if you want to determine the accessible income of a person, you need to distinguish between resident and non-resident. And so we took time to look at that, and we said that if you're a resident person, the law says that we have the power to tax all your income from investment, business, and employment. Then if you are a non-resident person, we have the power to tax only your income that is sourced from the country. Or if you are a permanent establishment, then we can also tax your income from the permanent establishment, the income that is attributable to the permanent establishment. So the concept of resident was very important as far as accessible income determination is concerned. So we took time to look at section 101, which tried to define what resident person is. So we saw 4 main types of resident person. We had resident individual, resident partnership, resident trust, and then resident companies. All of these things were critical in determining how we should assess the income of a person to tax. Then we said that, look, if we continue to hold on to this resident concept in our local law, we're going to have issues. You remember that jurisdiction has to do with the power. And so when we talk about tax jurisdiction, we're referring to the power to tax people. And because tax is an imposition, it's more like a compulsory something that we're going to force people to pay to the government. So holding on to the principle or what amounts to residents could result in issues. Because when we looked at section 101, we saw that an individual can be resident in about 2 countries. He can be a citizen, and he can also be in fact, we have people who have dual citizenship. So that alone could cause trouble. And particularly if you look at the definition of resident company in our law, we said that either you are registered under the Companies Act, Act 992, So we go to the Registrar General and we could find your records there. Or even if you are not registered in Ghana, but the management of the company is effectively conducted from Ghana, that amounted to a resident company. So Ghana had the rights or had the jurisdiction to tax you. So we said that holding on to these principles in the law could result in what we call the jurisdictional overlap or jurisdictional vacuum. Jurisdictional overlap means that you're going to have two countries fighting over a person because the person has dual residence. And vacuum means that people could manage their affairs in such a way that they will never belong to any residents at all, any country's resident at all. So these problems needed to be solved, and we said that to solve the problem there was the need for us to have a double taxation agreement or the double taxation treaty. So that's where we came from the local law to what we now discussing as international taxation. So immediately we introduced the international tax, and immediately we introduced tax treaty. Then we are talking about more or less like two countries. So we tried to define what tax treaty is, and we said that a treaty is any formally concluded or ratified agreement between two states. If it is between two states, we call it bilateral. And then if it is more than two states, then we call it multilateral. So we looked at this, we went through a lot of them. We looked at why we enter into a double taxation treaty. And I said that this one is highly examinable. You can be asked that what are the reasons why we enter, or what are the objectives of going into a double taxation treaties. And we said that one of them is to avoid double taxation. Of course, nobody wants to be taxed twice. And then to prevent tax evasion or tax avoidance. And then allocating tax jurisdiction, exchange of information, certainty of tax treatment to investors. We discuss all of these things. And the reason why I'm just recapping is that we said that normally tax treaties are more like a template. In other words, we have models of tax treaties. So we have the United Nations model or the template. If you want to do a tax treaty, you just go and pick it and then fix in the terms and the conditions you want. We also said that we have the OECD one. The OECD one is more like for the advanced countries. So there's a preference to that treaty. We normally use that treaty. And we have the United States one. So for exams purposes, and normally we refer to the United Nations one or the OECD one. The difference, we've already discussed them, so I wouldn't want to go into details of it. But what is important for the discussion of this topic is that we look at the various treaties. We look at the various articles. There are about 31 of them. Some of them are so critical and so important that you need to understand them before you go to the exams. For example, Article 4, you need to understand them. Permanent establishment, Article 5, you need to understand them. And Article 17. In fact, we've gone through most of them, which I believe that and by now you are familiar with Article 11, 12, 13, Article 10, Article 17. We have looked at them. Article 25, Article 24. These are the relevant articles that one needs to understand when you are talking about tax treaties. When we go to Article 9, I said that we're going to jump it because we're going to treat it as a topic, and that is why I've brought it up here. So Article 9, which is associated enterprise. For this small article generated the whole topic called the transfer pricing. And by now, I know you have looked at the other distributive articles. When we say distributive articles, like we mentioned earlier, they refer to how the tax amount will be distributed among the two countries. So when it comes to immovable property, who has a right to tax what? A dividend. All of these things we have discussed, the most important ones which you will need for exams. So, like I mentioned, today we want to start discussing Article 9. And like we said, Article 9 is one of the anti-avoidance provisions. So the discussion is going to focus on anti-avoidance. You look at Article 9, we have several of them. We have the application article, we have the definition articles, we have the articles that deals with double taxation elimination, and then we have the miscellaneous provision. Today we want to look at the anti-avoidance provisions, one of them, and one of them is what we are going to talk about as arm's length. So since Article 9 is about arm's length and we are saying that it is anti-avoidance provision, what it is, I know you have already discussed what tax avoidance and tax evasion is, but for the purpose of this lecture, let me just re-emphasize it one more. So transfer pricing, or the arm's length, going forward I may refer to it as transfer pricing. We will understand it more as we go along. So we try to distinguish between tax avoidance and tax evasion, and mostly we rely on what scholars and practitioners try to give the meaning to these two terms. And they are saying that there's always a thin line between what tax avoidance and tax evasion is. But first, let's look at tax avoidance, because that one is easy to identify. And one US Senate said that the Income Tax Act created more criminals than any other single act of government. In other words, if you are looking at tax evasion, things that goes into tax evasion, you will end up finding too many criminals. So what is tax evasion? The traditional definition is that anytime a taxpayer uses illegal means to reduce his tax or pay smaller tax or fraudulently underdeclare or not disclosing some incomes to the taxing authorities, then that is tax evasion. That is illegal. For example, you've gotten some money from your part-time activities or any income which is taxable and you refuse to disclose it or you pay the right taxes on it. That is tax evasion. That is illegal. The law, as we have in Ghana, has a lot of rules and provisions that deals with tax evasion. So we will not go into it too much. The major focus for our exams is tax avoidance. And tax avoidance, a British politician also said that the difference between tax avoidance and tax evasion is the thickness of the prison wall. What he's trying to say is that, one, if you commit the offense, you will not go to prison. The other, if you commit it, you will go to prison. So whereas tax evasion, you will go to prison, tax avoidance, you are likely not to go to prison. And so what is tax avoidance? So we are saying that where taxpayers use legal means, though it is unethical, if they use legal means to reduce their tax liabilities, that is tax avoidance. And we are saying that it is legal. In other words, you are trying to exploit the tax rules. We read this thing under section 99 and 98 of the Revenue Administration during our discussion, so I wouldn't go through them again. So we are saying that transfer pricing, or the arm's length standard, is one of the means for us to deal with tax avoidance. In other words, because it is legal, you have to design some rules called anti-avoidance provisions to deal with it, so that anytime somebody falls foul of that, or anytime somebody commits such acts, then you try to find out whether it is within the anti-avoidance provisions. Then we can apply the rules. So what we are going to talk about here is anti-avoidance rules. So anti-avoidance rules prevent the reduction of tax, and transfer pricing, or the arm's length standard, is one of the anti-avoidance rules that we are going to discuss. Let's take a minute to look at the various or the main types of anti-avoidance rules. We have specific anti-avoidance rules. In other words, those that are specific, we are able to tell they have occurred frequently, and research has shown that these are the specific ones people normally commit. These are the tax avoidance they normally engage in. They are specific. And the other one is also general. with the general anti-avoidance rules, people commit the tax avoidance, but you cannot pinpoint to say that this is what they've been doing. So with this particular general anti-avoidance rule, the law is made in such a way that we give too much discretion to the Commissioner General. Anytime he thinks that you have engaged in tax avoidance, then he can apply the rules. So you look at section 34 of the Income Tax Act 896, and then you notice that we have anti-avoidance rule, which is general anti-avoidance rule. Section 99 of the Revenue Administration Act, this one we've read it thoroughly. So you take a look at it and you notice that these are the two major or cardinal anti-avoidance provisions, general anti-avoidance provisions that we have in the law. We're not going to discuss the general anti-avoidance provisions. What we are going to deal with is the specific anti-avoidance rules. So what are they? The first one that we can think of is income splitting, section 32, where you attempt to split your income between two people or two related persons with the aim of reducing the tax. Maybe you have done this thing in audit, so we wouldn't go too much into it. Changing accounting dates under section 18, subsection 3. Changing control under section 62. And then think capitalization under section 33. Undistributed profit of companies, section 59, subsection 8. My focus is on the arm's length, which is the transfer pricing, section 31. And that is what we are going to discuss. So what is the transfer pricing or the arm's length standard? It's appeared in our rules in the Internal Revenue Act 2000. And if you look at the memorandum that was presented to Parliament, section 69 to 71 of the old law, the repealed law, says that these provisions are designed to give the Internal Revenue Service the power to deal with pernicious and increasingly sophisticated tax avoidance schemes aimed at avoiding tax in Ghana, specifically targeted at income splitting, transfer pricing, and think capitalization, which are the principal methods by which taxes are avoided or shifted to other jurisdictions. So this is what the law then indicated. So like the law has indicated, they are one of the sophisticated ways through which taxpayers avoid paying taxes. So that is going to be the focus of this discussion. So what is transfer pricing at all? The whole concept is that when parties who are in controlled relationship, in other words, they are related, for example, a parent and a subsidiary, when they are trading among themselves, they will normally agree on a price for the transaction. And the price that is agreed for which they are going to transfer the goods or services, what we normally call the transfer pricing. In other words, the price at which two people or two parties transact business. The technical definition by the OECD is saying that a transfer price is a price charged by a company for goods, services, or intangible property to a subsidiary or other related company. So when they are transferring goods, that is a transfer price. In itself, the transfer price is not the worry. It is not the problem that we have. Yes, they are free to price the goods and services, but the abuse of it is what we are concerned with. If you're a tax officer and you look at the way companies transfer goods and services among themselves, it gives opportunity for such companies to reduce or avoid paying tax in one jurisdiction or the other. So transfer pricing is not in itself illegal, or it is not necessarily an abuse. What is illegal is the mispricing. So why should you sell a laptop to your sister company at $1,000, but if you are selling to somebody who is not related to you, why will you sell it at, let's say, $10,000? What is the tax implication for such a transaction? And that is going to be the focus of this discussion. So the reason why we think that it gives opportunity to taxpayers is that sister companies will normally transact among themselves, and they will normally, I mean, if somebody is related to you, you will normally not sell the same price, the same thing to that related person. You can't sell the same price to the related person as if you are selling to a third party. In other words, if you are selling to a third party, the price is likely to be different from when you are selling to a related party. Imagine you are selling and your wife comes to your shop to say, I want to buy this. It's likely that you can even give it to your wife for free. But in taxation, the two entities are separate legal entities. And because of that, we are saying that the independent nature of you transacting with a third party should reflect in the same way you are transacting with a related party. But in most cases, it doesn't happen. That is why we are saying that transfer pricing gives opportunity for taxpayers to avoid paying taxes. And so if a company decides to pursue an aggressive transfer pricing, it can shift profit from one jurisdiction. For example, if Ghana has a higher tax rate, they will, at the end of the day, try and price goods to Ghana at a very higher price. And the more they price it, the costs or the expenses increases, and then Ghana will report a lower profit. When Ghana reports a lower profit, Ghana will pay lower taxes. At the end of the day, the profit is shifted to the group level, and the group is still able to make what they intend to do. In fact, transfer pricing is a major concern around the world. And if you look at the cases that have gone to court, they represent some of the huge liabilities. For example, in the United States versus Coca-Cola, there was $3.3 billion transfer pricing tax dispute. One other major issue that came up during the GlaxoSmith's US tax dispute was about $3.4 billion. And so these are huge amount of money. So countries around the world try to design transfer pricing rules to be able to help them deal with the problem. And so there is one major principle that globally we have agreed that when it comes to pricing among related parties, in order to avoid reducing the price for your sister company at the expense of the local tax authorities, there are some principles that we should adopt. So in designing the tax rules, we adopt those rules, and that rule, that standard, is what we call the arm's length standard. We are going to discuss the arm's length standard. So the whole topic that we'll be dealing with is called the arm's length standard. I believe that by now you have now seen where we are coming from the imposition of tax through double taxation treaties and the issue of tax avoidance, and the fact that transfer pricing is a major opportunity for tax avoidance. And therefore, how do we deal with transfer mispricing? We are saying that there is one standard that we must adopt, and that standard is what we call the arm's length principle. There are other methods or the other standards, but it seems the arm's length standard has dominated the world when it comes to taxation. So what is the arm's length standard? It says that where the price of a transaction is affected by a special relationship existing between related parties, leading to unfair tax treatment between tax jurisdictions, countries should adopt approaches to deal with the issue. And the most preferred method is the arm's length standard. There are other standards. They have not gained prominence. We will discuss them for purposes of exams, because in one of the questions we asked, discuss the arm's length principle, and then discuss the other principles that some economists and some other lawyers are advancing. So we will talk about the global formulary apportionment. We'll talk about other methods which deviate from the arm's length standard. We'll talk about thin capitalization, earnings stripping, and then all these things in our next discussion. Today's one is just to give you an overview of what the arm's length standard is. So just like the literal meaning, stretch your arms. So the arm's length standard is or the arm's length price is a price which is applied to transactions between persons other than associated enterprises. So if you go to the market and the person doesn't know you, he will sell to you at a price which is the market price. We don't want to use the market price. The correct terminology is the arm's length. And like we mentioned, the arm's length standard is the cornerstone, in fact the basis of Article 9. So you notice that we have gone back to the treaty and we are going to discuss Article 9. Because Article 9 contains so much information, we have designed a whole book for it, and we'll be using the transfer pricing guidelines. So what does the Article 9 say? Article 9 says that where conditions are made or imposed between the two enterprises in their commercial or financial relations. Look at the term used, commercial or financial relations. When you hear this term, then it means that it has something to do with profit. Commercial or financial relations which differ from those which would be made between independent enterprises. Then any profits which would, but for those conditions, have accrued to one of the enterprises, but by reason of those conditions have not so accrued, may be included in the profits of that enterprise and taxed accordingly. This is a treaty provision. So anytime related parties have commercial or financial relationship, and because of that special relationship existing between those two related parties, some profit has accrued unevenly, then they are free to adjust those profits and tax them accordingly. Indeed, this arm's length standards did not start now. It started long ago in 1920, and then later was adopted in 1963 in the OECD model. So it is an international standard which is mostly preferred to all other methods. So we'll look at the other methods and then you can make your own judgment on that. So under the arm's length standard, where extra profits result from a non-arm's length transaction, and when we say non-arm's length means that related party. See, when somebody is related to you, you don't need to stretch your arm fully, like your spouse on your spouse is related to you. So if you want to reach out to your spouse, the person is close to you, so you don't stretch your arms. But if somebody is not related to you, if the person is very far away, it's not a relation, it's not a relative, you deal with him on a market to market level, mostly determined by market conditions. That is what we want tax transactions to reflect. Don't use your special relationship to limit the profits. If you do that, you are cheating one country and the other country is profiting. We don't want that to happen. That is why the arm's length approach seems to be adopted. So the OECD transfer pricing guidelines is what we are going to use. Like I showed you, this book is the major book that we'll be using. is the major book that we'll be using. So if you don't have it now, I guess that you should look for it, and then we'll start reading. There are about 10 chapters in all. We'll be doing the relevant chapters in them. Great. So how do we find the arm's length price? We are saying that when you are transacting, look for the arm's length price and use it to treat your related party. So the OECD model or the arm's length principle has advanced at least 5 main methods that we will have to use to identify the arm's length price. Each of these things are considered in each special situation. We will be talking about them in our next lecture when we are looking at the arm's length method. They are very, very important. Why do we prefer the arm's length standard? And we are saying that there are several reasons. One of them is that it gives us a very comparable basis to treat multinationals. If you can treat a third party in one way, then be fair and treat your related party in another way, in the same way. So, because the arm's length principle puts independent enterprises on equal footing, there is no tax advantage. You can't have unfair treatment when it comes to taxation. So treat your sister company the same way you are treating a third party, so that at least the tax authorities will get their fair share of taxes. Okay. In fact, the arm's length principle is the open market price. It is the closest approximation of open market price, and so it becomes easier when you are a tax administrator. It's easier and in determining how much profit should have been accrued to one entity. So we will go through these things. I will jump this one because we are going to look at it in detail. The problems with the arm's length principle, we will look at it in detail when we are considering the global formula apportionment. Like I said, today's lecture is just to give you few concepts about the arm's length principle and then show you what to read. In fact, the arm's length principle or the arm's length standard is what has been adopted, and so in our Income Tax Act section 31 we have it there. It says arm's length standard and arrangement between associates. Subsection 1 says that where an arrangement exists between persons who are in controlled relationship, and this word we are going to see it a lot, control relationship, the person shall calculate their income and tax payable according to the arm's length standard. So even in the local law, it says that if there is an associate or there is a subsidiary, as long as there's a related party and you are dealing with them, the most preferred standard is that it should be at the arm's length standard. So get this concept. What is the arm's length standard? What are the benefits of the arm's length standard? What are the problems of the arm's length standard? We have examined questions. We have examined students on this before, so we'll look at it. So 2 says that the arm's length standard requires persons who are in control relationship to quantify, characterize, apportion, and allocate amount to be included in or deducted from income to reflect an arrangement that would have been made between independent persons. So we are saying that yes, you are related, but have this independent relationship existing. As long as you are in a control relationship, make sure everything you do, when you are allocating expenses, when you are apportioning income, whatever you do it as if you are independent persons. Then it goes on to say the minister may by legislative instrument make regulations on matters relating to transfer pricing and application of the arm's length standard. And this one led to the promulgation of the transfer pricing regulations 2020. We had the transfer pricing regulations LI 2188 2012. This one has been repealed, so we are not using the 2012 version anymore. We now have the 2020 version, which we will be using in our lecture. The transfer pricing regulations is what we are going to use. So, ladies and gentlemen, it's 35 minutes. I wouldn't want to have very long lecture. Today's one is just to tell you what is contained under Article 9. So our next lecture is going to focus on the exams, and we are going to use this book. Now, I want us to look at Chapter 1 of the Transfer Pricing Guidelines. Please, it is an examinable area and gives the basic concept of transfer pricing or the arm's length standard. So look at paragraph 1.1, 1.2 to 1.4. It will tell you why we are introducing the arm's length standard. Look at paragraph 1.6. Look at paragraph 1.8 to 1.32. And then, for your own sake, for your own examination purpose and preparation, please prepare your own summary on paragraph D. Look at page 53 going. Paragraph D, there is a summary version of the whole arm's length principle. Get it, summarize it. We will solve questions on it when we meet in our next lecture. Like I said, we don't want to have a longer recording, so we will end here and then we'll continue in our next recording. See you soon.